Before we dive in, a quick but important note. I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The information shared in this video should not be considered financial advice. Investing involves risk, including the potential loss of principal. Always do your own research and consider consulting with a qualified financial professional before making any investment decisions. Your financial situation is unique, and the choices you make should be tailored to your specific goals and risk tolerance. What if I told you there's a corner of the stock market that has been quietly, consistently outperforming the giants we all know and love? A sector that many financial experts call the sweet spot of investing. Yet the average person with a 401k or a brokerage account completely overlooks it. This isn't about some risky crypto coin or a speculative startup. This is about a group of established, powerful American companies hiding in plain sight. And ignoring them could be the single biggest reason your portfolio feels like it's stuck in second gear. You've probably done what you're supposed to do. You're putting money away, you're invested in a fund that tracks the S&P 500, watching companies like Apple, Microsoft, and Amazon. And that's great, it's the foundation. But let's be honest. Does it feel a little boring? A little slow? You see these titans of industry, these trillion-dollar companies, and you know their explosive 10 times your money growth phase is long gone. A company worth $2 trillion isn't going to become a $20 trillion company overnight. The growth is steady, but it's incremental. It feels like you're on a massive, safe cruise ship. It's comfortable, it'll get you there eventually, but it's not exactly a speedboat. On the other end, you hear about small-cap stocks, the exciting, high-risk startups that could be the next big thing, or could go bankrupt next Tuesday. That feels like jumping on a jet ski in a hurricane. It's too much risk, too much volatility for your hard-earned money. So you're stuck in this dilemma. The giants are too big to grow explosively, and the startups are too small to be safe. It feels like your only choices are slow and steady, or bet the farm. This is where you've been misled. Because between the lumbering cruise ships and the risky jet skis, there's an entire fleet of powerful, agile speedboats ready to fly. This is the world of mid-cap stocks. And by the end of this video, you will understand exactly what they are, why they represent what might be the most potent growth engine for the modern investor, and how to start thinking about the incredible rewards and the critical risks that come with them. We are going to demystify the most overlooked asset class in America. So what on earth is a mid-cap stock? The cap is short for market capitalization, which is just a fancy way of saying a company's total value on the stock market. You calculate it by taking the price of one share and multiplying it by the total number of shares out there. It's the sticker price for the whole company. Large cap companies are the household names. Think Coca-Cola, Johnson & Johnson, Google. These are the blue-chip behemoths, typically valued at over $10 billion. They are the established adults of the corporate world. They're stable, they often pay dividends, and they dominate their industries. Small-cap companies are the opposite. They're the energetic newcomers, valued somewhere between a few $100 million and $2 billion. They might have a great new product or a disruptive idea, but they're often not yet profitable and their future is uncertain. They are the talented but unproven high school athletes. Mid-caps are the companies thriving in the space right in between. Generally, these are companies with a market capitalization between $2 billion and $10 billion. They're not startups in a garage and they're not global empires. They are the Goldilocks of the stock market. Not too big, not too small. They are the college all-stars who are just about to get drafted into the major leagues. You might not know all of their names, but you've definitely used their products. Think of companies that are leaders in their specific niche. A successful regional bank, a popular restaurant chain that's expanding nationally, or a technology company that provides critical software for a specific industry. This is where the magic happens. A mid-cap company has already survived the brutal startup phase. They've proven their business model works. They have real products, real customers, and most importantly, real growing revenue. They've figured out how to be successful. They've moved past the existential risk that haunts small caps. But here's the key. They are still small enough to have a massive runway for growth ahead of them. Let's use some simple math. For a $2 trillion large-cap company like Microsoft to double in value, it has to find an additional $2 trillion in market capitalization. That requires a monumental, world-changing effort. It's like trying to turn a battleship on a dime. But for a $5 billion mid-cap company to double, it just needs to become a $10 billion company. That's still a huge accomplishment, but it's a far, far more achievable goal. It's still in its high-growth phase. It can innovate faster, pivot to new opportunities, and gain market share from its larger, slower competitors. These companies are hungry. They are run by ambitious founders and executives who are still trying to make their mark on the world, not just manage a legacy. This is why they're called the sweet spot. Mid-caps often possess the perfect blend of qualities. They have the financial stability and established market presence of a larger company, combined with the growth potential and agility of a smaller one. You're investing in companies that have already won the first round and are now poised for their biggest breakout. You are essentially buying tomorrow's large caps today, before they become household names, before everyone else piles in and the explosive growth phase is over. So, if these companies are so great, how do you actually invest in them? Trying to pick individual mid-cap stocks is incredibly difficult. For every mid-cap that becomes the next Chipotle, there are dozens that flame out or get acquired for a disappointing price. It requires an insane amount of research, and even the professionals get it wrong all the time. For most of us, this is where the mid-cap mutual fund comes in. A mutual fund is simply a professionally managed portfolio that pools money from thousands of investors to buy a collection of stocks. A mid-cap mutual fund, therefore, is a fund that specializes in buying a diversified basket of these $2 to $10 billion companies. Instead of betting your money on one single company, you're spreading your investment across 50, 100, or even more of these high-potential businesses. This instantly diversifies your risk. If one company in the fund has a bad quarter, it's cushioned by the 99 others that are doing well. You get access to the growth potential of the entire mid-cap sector, without the stomach-churning risk of trying to find the one single needle in the haystack. You're hiring a full-time team of analysts and portfolio managers whose entire job, all day every day, is to find the best mid-cap companies in the country. We've just defined the what, the powerful but overlooked world of mid-cap stocks, and the why, their unique position as a growth engine. We've also touched on the how, using mutual funds as our vehicle to access them. But understanding the concept is just the first step. To truly invest with confidence, we need to go deeper. We need to dissect the specific rewards you can realistically expect, and more importantly, we must confront the very real risks and hidden pitfalls that you absolutely have to be aware of before you even think about investing. Because in the world of mid-caps, the line between incredible opportunity and unnecessary risk can be razor thin. So let's peel back the curtain, starting with what I call the forgotten middle child syndrome. Think about it. The stock market is a family. The large caps, the Apples, the Microsofts, the Amazons, they're the oldest sibling. They're reliable, famous, and everyone knows their name. Every move they make is headline news on CNBC. Then you have the small caps. They're the exciting, unpredictable youngest child. Full of explosive potential. They get all the speculative buzz from investors dreaming of finding the next 10-bagger. And then there are the mid-caps. Stuck in the middle. They're too big to be the exciting new thing, but not big enough to be the established blue-chip titans. And this isn't just a metaphor. It has profound, real-world consequences for your money. The biggest consequence is a glaring lack of attention. The army of Wall Street analysts that covers every microscopic detail of a company like Google, that army is a tiny platoon when it comes to the mid-cap space. A typical large-cap stock might be followed by 30, 40, even 50 professional analysts. A mid-cap? It might be lucky to have 5, or 3, or sometimes none at all. This creates an information vacuum. It means that the stories, the data, and the deep dive research are simply not as readily available. For a mutual fund manager, this is a double-edged sword. On one hand, it's an opportunity for a truly skilled manager to find undervalued gems that the rest of the market has ignored. But on the other hand, it's a massive risk. It means they are operating with less information, and if your fund manager isn't truly at the top of their game, they're essentially flying with foggy instruments. They might miss a critical flaw in a company's business model, or an emerging threat from a competitor simply because no one was there to report on it. You, as an investor in their fund, are betting not just on the companies, but on the manager's ability to be a world-class investigative journalist, not just a number cruncher. That is a much higher bar. This lack of attention feeds directly into the second, and perhaps most emotionally taxing risk, gut-wrenching volatility. Now, everyone says stocks are volatile, but it's different with mid-caps. They exist in a precarious balance. They don't have the fortress-like balance sheets and diversified revenue streams of large caps that can cushion them during a market downturn. When a recession hits or interest rates spike, a large cap company might see its profits dip. A mid-cap company might see its profits evaporate entirely. At the same time, they don't have the lottery ticket appeal of small caps, where investors are willing to stomach insane swings for a shot at a 1,000% return. So when the market gets choppy, mid-caps often get hit from both sides. They are sold off more aggressively than large caps because they're seen as riskier, but they don't attract the same wave of bargain-hunting speculative buyers that small caps do. The result is sharp, painful drops that can truly test your resolve. It's one thing to see your large-cap fund go down 10%. It's another to see your mid-cap fund plummet 25% in a matter of weeks, while the evening news is completely silent about the companies you own. That silence is terrifying. It creates a feeling of isolation and doubt. You start to wonder, what do they know that I don't? This is the exact moment when the average investor makes the biggest mistake of their life. They panic. They sell at the bottom, locking in devastating losses, just before the eventual rebound. The volatility of mid-caps isn't just a number on a screen. It is a psychological weapon that can trick you into sabotaging your own financial future. But let's say you have nerves of steel. You can handle the volatility. There is a far more insidious structural risk lurking beneath the surface that even seasoned investors forget: the liquidity trap. Liquidity is just a fancy word for how quickly you can sell something without crashing its price. Selling $1 million of Apple stock is like pouring a cup of water into the ocean. The market barely notices. Now try selling $1 million of a $6 billion mid-cap company. It's not a cup of water in the ocean. It's a boulder dropped into a swimming pool. It makes a huge splash, and the waves can capsize other boats. Now, why does this matter to you in a mutual fund? Because you aren't the only investor. Imagine the market takes a dive. A few large, institutional investors in your mid-cap fund get nervous and decide to pull their money out. They request redemptions worth hundreds of millions of dollars. To pay them, your fund manager has to sell stocks. But they can't just sell a little bit of everything. They have to sell large blocks of these mid-cap stocks, the very ones that are hard to sell without tanking the price. So to get the cash quickly, they are forced to sell these shares at a steep discount. Who pays the price for that discount? You do. The remaining investors in the fund. The manager's forced selling drives down the value of the stocks you still own, creating a vicious downward spiral. Your fund's value drops not just because the market is down, but because the fund's own actions are making it worse. It's a silent portfolio killer that happens behind the scenes, and it's a direct result of the illiquid nature of the forgotten middle. Finally, we have to talk about the most strategic, and perhaps most misunderstood risk of all: the growth trap. Many mid-cap companies are not just mid-sized businesses. They are former small-cap superstars. They are the companies that already had their explosive growth spurt. They're the high school quarterback who won the state championship and is now playing for a decent college team. The market, however, still expects them to play like a Heisman Trophy winner. Investors have priced these stocks for perfection, assuming the incredible growth of their past will continue indefinitely into the future. This is a fundamentally dangerous assumption. The strategies that get a company from $500 million to $5 billion in value are often completely different from the strategies needed to get from $5 billion to $50 billion. The company is now in a new, more difficult weight class. It's too big to be nimble and outmaneuver competitors, but it's too small to have the pricing power, brand recognition, and global reach of a large-cap leader. They are caught in no man's land. To satisfy Wall Street's insatiable demand for growth, these companies might start making desperate moves. They might make a huge, risky acquisition outside of their core expertise, or they might take on massive debt to expand into new markets they don't understand. They are chasing growth at any cost. A mid-cap mutual fund that is filled with these kinds of companies is a ticking time bomb. The fund might boast fantastic 5-year returns, but it's based on a growth story that has already ended. You're buying in at the peak, just as the company is about to run out of steam and fall from its pedestal. So, with all these landmines, the forgotten middle child syndrome leaving you in an information blackout, the gut-wrenching volatility designed to make you panic sell, the hidden liquidity traps that can bleed your portfolio dry, and the dangerous growth illusions that lure you in with past performance, you might be asking yourself, why would anyone on earth even consider this? Why walk willingly into this minefield? The question is not just fair. It's essential. And the answer is what separates savvy investors from the crowd. Because, on the other side of that risk, lies a potential that is almost mathematically impossible to find in any other part of the market. It's a unique intersection of growth and stability that we call the Goldilocks zone. And understanding how to find it, well, that's the secret key to unlocking truly transformative wealth. So what exactly is this Goldilocks zone? It's not just a cute fairy tale name. It's a specific, identifiable set of characteristics that separate the future titans of industry from the flashes in the pan. Think of it as a 4-point inspection for a company that's graduated from the minor leagues and is ready for its shot at the big time. The first and arguably most important characteristic is a proven business model. This is non-negotiable. We're not talking about a company with a cool idea on a napkin and a prayer. We're talking about a business that has already demonstrated that people want what they're selling. They have real customers, real revenue, and a product or service that solves a genuine problem. They've survived the brutal Darwinian world of startups where most businesses fail. They've found what we call product market fit. This single factor removes a massive layer of risk compared to small cap investing. You're not betting on an unproven concept. You're betting on the successful expansion of a concept that already works. Second, they must have a significant growth runway. This is the flip side of the coin. Yes, their model is proven, but their market is far from saturated. A large cap company, say a massive soda brand, is already in nearly every country on every store shelf. How much bigger can it realistically get? Its growth is limited. A mid-cap company, however, might have a fanatically loved product that's only available in one region of the country. They have the entire rest of the nation, and potentially the world, left to conquer. Their addressable market is vast. This is where that explosive 10-bagger potential comes from. They have the room to run, to expand, to multiply their revenue in a way that a corporate giant simply can't anymore. Third on our checklist is the professionalization of management. This is a subtle but critical transition. A small cap might be run by its brilliant but perhaps eccentric founder. They're the heart and soul, but they might be handling marketing, finance, and product development all by themselves. A true Goldilocks mid-cap has begun to build a professional C-suite. They've hired an experienced chief financial officer who knows how to manage cash flow for rapid expansion. They've brought in a veteran head of sales who knows how to build a national sales force. This signals that the company is maturing. It's moving from a personality-driven startup to a process-driven organization capable of scaling responsibly. It's a sign that they're building the corporate machinery needed to handle the explosive growth they're chasing. And fourth, there must be a clear and believable path to profitability, if they're not there already. Many of the best mid-caps are already profitable. They're self-sustaining engines of growth. But even if they're still investing heavily in expansion and showing a net loss on paper, you can see the underlying health. You can look at their gross margins, their customer acquisition costs, their recurring revenue, and see a clear line of sight to a future where the profits will be substantial. This isn't the growth at all costs mentality of a cash-burning startup hoping for a buyout. This is strategic, disciplined investment in a business with solid fundamentals. Let's make this real. Imagine a local, family-owned restaurant. It's got the best burgers in town. That's our small cap. It's fantastic, but its success is tied to one location, one family. A bad kitchen fire or a new competitor next door could wipe it out. It's high risk, high reward. Now think of a global fast food chain. That's our large cap. It's everywhere. It's stable, predictable, and pays a nice dividend. But it's not going to double in size next year. Its growth is slow and incremental. It's safe, but the potential for life-changing returns is long gone. The Goldilocks zone is the burger joint that perfected its recipe, systemized its operations, and has successfully opened 10 more locations in the surrounding counties. They're a regional powerhouse. They're no longer a fragile family business, but they're not a saturated global behemoth either. They've just secured funding to expand into the 3 neighboring states. They have a proven product, a massive growth runway. They've hired professional managers to oversee the expansion, and each new location is profitable within 6 months. That is the mid-cap sweet spot. That's where the magic happens. You get the established quality of a proven business with the explosive growth potential of a national expansion. Now here's the key. As an individual investor, identifying these companies is hard. It takes an immense amount of research, financial analysis, and industry expertise. You'd have to spend your entire life reading quarterly reports and listening to earnings calls. This is precisely where a mid-cap mutual fund comes into play. A good mid-cap mutual fund manager is a professional scout for these Goldilocks companies. Their entire job, their entire team's job, is to live and breathe this world. They aren't just looking at the numbers. They're meeting with the management teams, touring the facilities, analyzing the competition, and building complex models to project future growth. They are professional burger critics, if you will, looking for the next great regional chain before it goes national. And they don't just find one, they build a portfolio of them. The fund might own a piece of that rapidly expanding restaurant chain, but it also owns a piece of a regional bank that's innovating in fintech, a software company that's cornered a niche market, and a medical device maker whose new product just got a green light. This diversification is your built-in safety net. If the burger chain's expansion into a new state fails, it's a disappointment, but it doesn't sink your entire investment. The success of the software company or the medical device maker can easily offset that loss. A mutual fund spreads your bet across dozens, sometimes hundreds of these high-potential companies, all of which have passed that rigorous 4-point inspection. You get access to the explosive growth of the Goldilocks zone, but with a powerful layer of diversification that you could never achieve on your own. But this story isn't all sunshine and perfectly cooked burgers. The Goldilocks fairytale has a darker side. There are bears in these woods. While these companies have outgrown many of the risks of the startup world, they face a new and unique set of dangers. The very growth that makes them so attractive is also a source of immense pressure and potential failure. The path from regional player to national leader is littered with the corpses of companies that couldn't handle the journey. This is what separates a savvy investor from a naive one. It's not enough to just see the potential reward. You have to understand, respect, and plan for the potential risks. What happens when the porridge is too hot? What happens when the chair is too hard and breaks? These aren't just abstract questions. They represent real financial dangers. Dangers like execution risk, where a company's brilliant expansion plan completely falls apart in practice. Or valuation risk, where market hype pushes the company's stock price to unsustainable levels, creating a bubble just waiting to pop. And there's the ever-present threat of competition, where a sleeping large-cap giant suddenly wakes up and decides to enter the mid-caps market, using its massive resources to crush the smaller player. Understanding these threats is the other half of the equation, the part that protects your capital and allows you to invest with confidence instead of fear. So let's dissect that equation. Let's pull back the curtain on the specific threats, the hidden landmines, that every mid-cap investor needs to navigate. Because confidence isn't born from ignorance, it's forged in knowledge. The first and most famous risk is volatility. You've heard the word 1,000 times, but what does it actually mean for your money? Imagine you're on the ocean. A large-cap fund like one tracking the S&P 500 is a massive cruise ship. It's enormous, stable, and when a storm hits, you feel the rocking shore. But the ship plows through the waves with immense inertia. It turns slowly, it accelerates slowly, and it's incredibly difficult to sink. A mid-cap fund, on the other hand, is more like a high-performance speedboat. It's incredibly fast, agile, and can change direction on a dime. When the seas are calm and the sun is out, there's nothing more exhilarating. You're flying across the water, leaving the lumbering cruise ships in your wake. This is the feeling of a mid-cap fund during a bull market: explosive, thrilling growth. But when that storm rolls in, the experience is completely different. That speedboat is now being tossed around by every single wave. The highs are higher, but the lows are terrifyingly lower. You're not just rocking, you're being slammed, lifted, and dropped. That's volatility in a nutshell. The price of your mid-cap mutual fund can, and will, swing much more dramatically than a large-cap fund. A 10% drop in the broader market might translate to a 20 or even 30% drop in your mid-cap fund. For the unprepared investor, this is a gut-wrenching, panic-inducing nightmare. They see their statement in the red, they imagine losing everything, and they sell at the absolute worst possible time, locking in their losses right at the bottom. The savvy investor, however, understands this is just the nature of the speedboat. They've prepared for the storm, they have their life vest on, and they know that once the storm passes, the speedboat is still the fastest vessel to get them to their destination. Understanding volatility isn't about avoiding it. It's about expecting it, bracing for it, and not letting it trick you into making emotional, wealth-destroying decisions. The second risk is more subtle, but in a crisis it can be even more dangerous. It's called liquidity risk. Liquidity is simply how quickly you can sell an asset for cash without affecting its price. Think about selling a share of Apple. There are millions of buyers and sellers every single second. You can sell 10,000 shares or 10 shares, and the market will barely notice. It's like selling a bottle of water in the desert. There's always a buyer. That's a highly liquid asset. Now, think about a mid-cap company, maybe a regional bank or a specialized software firm. It's a great company, but it's not a household name. There might only be a few thousand shares traded each day. Now imagine you're a mutual fund manager who owns 1 million shares of this company. If you need to sell your position quickly, perhaps because investors in your fund are panicking and pulling their money out, you have a massive problem. You can't just dump 1 million shares onto a market that only trades a few thousand a day. It would be like trying to drain a swimming pool through a garden hose. The moment you start selling in large quantities, you create a supply shock. There aren't enough buyers at the current price, so the price starts to plummet. You, the fund manager, are now forced to sell at lower and lower prices just to get the cash you need to pay back your own investors. This creates a vicious downward spiral. The fund's value drops, which causes more investors to panic and sell, which forces you to sell more liquid stock, which pushes the price down even further. It's a fire in a crowded theater. This is liquidity risk. It's the hidden danger that a fund might hold fantastic companies on paper, but in a market panic, the inability to sell those holdings efficiently can decimate returns for everyone involved. It's a risk that doesn't show up on a sunny day, but during a storm, it can be the rogue wave that sinks the entire ship. This leads us directly to the third, and perhaps most human risk of all, management risk. With many large-cap index funds, the manager is almost irrelevant. The fund simply buys the 500 biggest companies, and the job is mostly automated. But the mid-cap space is a jungle. It's an inefficient market filled with hidden gems and spectacular flameouts. This is where a talented fund manager can truly shine, picking the winners and avoiding the losers. And that's the problem. The success of an actively managed mid-cap fund is often tied, almost completely, to the skill, strategy, and vision of a single person or a very small team. They are the star quarterback, the master chef, the genius conductor. But what happens when the star quarterback retires, or worse, gets poached by a rival team? Imagine a fund called the Pioneer Mid-Cap Growth Fund, run by a legendary manager named Sarah Jones. For a decade, Sarah has delivered incredible returns. She has a unique knack for finding obscure tech companies before they hit the big time. Investors flock to her fund, entrusting her with billions of dollars. Her name is the fund's brand. Then one Monday morning, a press release hits the wire. Sarah Jones is leaving to start her own hedge fund. Chaos ensues. Investors who put their money in the fund because of her now rush for the exits. This triggers the very liquidity crisis we just talked about. The new manager who takes over, no matter how competent, is left to clean up the mess. They have to sell assets into a falling market to meet redemptions, and they don't have Sarah's magic touch. The fund's performance collapses. This isn't just a hypothetical. It has happened time and time again. It's called keyman risk. And in the world of mid-cap mutual funds, you are often betting as much on the manager as you are on the stocks they pick. You have to ask yourself, am I investing in a durable process, or am I just investing in one person's hot streak? Because streaks, by their very nature, eventually end. Finally, we have to confront the beast of economic sensitivity. Mid-cap companies are the backbone of the American economy, but they are also its most sensitive nerve. Large-cap behemoths, the Procter & Gamble's, the Cokes, the Walmarts, are like global empires. They have diversified revenue streams from dozens of countries. If the US economy slows down, they can lean on their sales in Europe or Asia. They have immense pricing power. When their costs go up, they can pass it on to consumers, and people will still buy their toothpaste and soda. They have access to incredibly cheap debt, allowing them to borrow money to survive even the harshest economic winters. Mid-caps don't have these luxuries. Their fortunes are often tied directly to the health of the US economy. They are more likely to have a concentrated customer base. They have less power to raise prices without losing business. When the Federal Reserve starts hiking interest rates to combat inflation, it hits mid-cap companies the hardest. Their borrowing costs skyrocket. Their customers, feeling the pinch, cut back on spending. A mild recession for a large-cap giant can feel like a depression for a mid-cap company fighting for survival. This means that a mid-cap mutual fund is, by its very design, a leveraged bet on domestic economic prosperity. When the economy is booming, they will soar higher and faster than their large-cap cousins. But when the cycle turns, and it always does, they will feel the pain more acutely. Their fall will be faster and steeper. Ignoring the economic cycle when investing in mid-caps is like sailing that speedboat directly into the path of a known hurricane, simply because the sun is shining today. So with all these landmines, the gut-wrenching volatility, the hidden liquidity traps, the risk of a star manager walking out the door, and the extreme sensitivity to every economic tremor, you might be asking yourself, why would anyone even bother with this? That is the billion-dollar question. And the answer, the secret that separates average investors from wealthy ones, lies in understanding how to turn these very risks into your greatest advantage. It's about knowing which landmines to avoid, and which ones are actually guarding buried treasure. That's exactly where we're going next. So let's start with the most obvious landmine, the one with the big flashing warning sign: volatility. This is the one that scares most people away from mid-caps. We've all seen the charts that look like a heart monitor during a panic attack. One day you're up 7%, the next you're down 5%. It feels chaotic, unpredictable, and frankly stressful. And it's not just a feeling. It's a reality. Mid-cap stocks are inherently more volatile than their large-cap cousins. A piece of bad news about a single product line, a shift in consumer trends, or a new competitor can send a mid-cap stock tumbling in a way that would barely make a dent in a behemoth like Apple or Microsoft. These companies don't have the massive, diversified revenue streams to absorb shocks. They are more sensitive, more tuned into the vibrations of the economy. The landmine here is your own human psychology. When the market drops 10% and your mid-cap fund drops 15%, the primal part of your brain screams, "Get out." It tells you to sell, to cut your losses, to run for the safety of cash or stable large caps. And every single time you listen to that voice, you detonate the landmine. You turn a temporary, on-paper dip into a permanent, real-world loss. This is the classic, tragic mistake that separates amateur investors from seasoned wealth builders. They see volatility as a threat to be avoided, but the buried treasure is right there, hidden in plain sight. You have to completely reframe what volatility is. Volatility is not just risk. Volatility is the price of admission for higher returns. It is the raw energy of the market. Think of it like this. A calm lake is safe, but it's not going to get you anywhere. A raging river is dangerous, but it has immense power. If you know how to navigate it, that power can carry you to your destination much, much faster. The swings, the dips, the downturns in mid-caps, those aren't signals to sell. For the investor with the right mindset and, crucially, the right time horizon, they are massive flashing sales signs. They are opportunities to buy more shares of incredible, growing companies at a discount. When others are panicking and selling, you are acquiring future growth at yesterday's prices. The treasure isn't in avoiding the roller coaster. It's in knowing that the scary drops are what give the ride the momentum to climb to even greater heights. You turn volatility from your enemy into your greatest ally, simply by having the patience to outlast the fear. Now for the second landmine, which is a bit more subtle. It's called liquidity risk. It's a fancy term for a simple concept. How easily can you sell something without the act of selling it causing the price to drop? If you own a few shares of Amazon, you can sell them in a fraction of a second, and your sale will have zero impact on Amazon's stock price. There are millions of buyers and sellers every single minute. It's a superhighway of transactions. But mid-cap stocks are more like a two-lane country road. There's less traffic. Now, imagine a mutual fund that owns a huge position, say 5%, of a promising mid-cap tech company. If that fund manager decides to sell that position, it's like a convoy of 18-wheelers trying to exit on a tiny country lane. They can't just dump all their shares at once. Doing so would flood the market, overwhelming the number of buyers and causing the stock price to plummet. They have to sell it off slowly, carefully, but even then, their selling pressure can drag the price down. This is the landmine. A fund can get stuck in a position, unable to get out at a good price, especially during a market panic when everyone is trying to sell at the same time. This can hurt the fund's performance and, by extension, your returns. It's a hidden friction that can slow down even the smartest managers. But like before, where there's a trap for the unwary, there's treasure for the wise. The very same illiquidity that poses a risk is also the source of massive opportunity. Why? Because the Wall Street giants, the multi-billion-dollar hedge funds and colossal large-cap mutual funds, often can't even play in this sandbox. They have too much money to deploy. For a $100 billion fund, buying a position in a $2 billion mid-cap company is pointless. Even if that company doubles, it would be such a small part of their portfolio it wouldn't even move the needle. They can't buy a big enough stake without distorting the price and becoming the entire market for that stock. So they don't even look. This creates an incredible inefficiency. It means hundreds of fantastic, high-growth mid-cap companies are flying completely under the radar of the big institutional players. They are underanalyzed, misunderstood, and often mispriced. This is the hunting ground for brilliant fund managers. They can find absolute gems, companies with revolutionary technology, impenetrable moats, and visionary leadership, and buy them for a fraction of their true worth, precisely because they are operating on that less traveled country road. The liquidity risk is a barrier to entry that keeps the big, dumb money out, leaving the field open for skilled stock pickers to find the buried treasure that Wall Street is too big to see. Your investment in a good mid-cap fund is a direct bet on this inefficiency. This brings us to the third, and arguably the most important landmine management risk. With a large cap index fund like one that tracks the S&P 500, the manager doesn't matter that much. Their job is just to buy the 500 biggest companies and stay out of the way. It's a passive automated process. But in the world of mid-caps, you are not betting on an index. You are betting on a person. You are betting on the fund manager and their team of analysts. The landmine is a mediocre manager. A manager who just follows the herd, who gets caught up in hype cycles, who doesn't do the deep boots-on-the-ground research required to truly understand these complex, evolving businesses. In the mid-cap space, a few bad decisions can be catastrophic. A company that looked like a sure thing could have its patents invalidated, its CEO could leave, or its one big customer could go bankrupt. These aren't like blue-chip stocks that can weather any storm. A bad bet on a mid-cap can go to zero. A fund run by a weak manager is like a ship with a blind captain sailing through an iceberg field. It's not a matter of if it will hit something but when. So what's the treasure? It's the flip side of that coin. It's the all-star manager. It's the person whose skill, discipline, and insight become your single greatest competitive advantage. Because the mid-cap universe is so vast and underanalyzed, a truly great manager can generate alpha, that is, returns above and beyond the market average, in a way that's almost impossible in the hyper-efficient large-cap space. These managers aren't just looking at spreadsheets. They are visiting the factories. They are talking to a company's customers and its competitors. They are grilling the management team. They are trying to understand the culture, the vision, and the intangible qualities that separate the winners from the losers. When you invest in a top-tier mid-cap fund, you are essentially hiring a world-class team of business analysts to work for you, finding those next-generation leaders before the rest of the world catches on. The risk is that you pick a bad manager, but the reward, the buried treasure, is that you find a great one. You hitch your wagon to an expert navigator who knows how to read the currents, who sees the storm clouds long before they appear on the horizon, and who knows exactly which country roads lead to chests of gold. The entire game in mid-cap investing isn't just about picking the right stocks. It's about picking the right person to pick the right stocks for you. So we have these three core risks: the psychological terror of volatility, the hidden friction of illiquidity, and the critical dependence on the fund manager. But as we've seen, each one contains the seed of its own incredible reward. The key is no longer just knowing the risks exist, but knowing how to evaluate them. How do you find a fund that has a strategy for navigating volatility? How do you assess if a manager is using illiquidity to their advantage? And most importantly, how in the world do you separate a truly great fund manager from a lucky one? That's the billion-dollar question. And it requires a completely different set of tools than just looking at past performance. So let's start building that toolkit. Think of yourself less as a passive investor and more as a detective. You're not just looking at the final score of the game. You're watching the game tape, analyzing the coach's strategy, and even interviewing the players. The first and most critical clue you're looking for is a clearly defined, repeatable investment process. This is the manager's playbook. A great manager should be able to explain their philosophy to you in a way that makes sense. Are they a value investor, hunting for bargains the market has overlooked? Are they a growth investor looking for the next rocket ship? Are they something in between? It's not about which style is better. It's about consistency. Does their process make logical sense, and have they stuck with it through thick and thin? A manager who chases whatever is hot, jumping from tech stocks one year to energy stocks the next, isn't a strategist, they're a trend follower. And trends, by their very nature, eventually end, often abruptly. You want a manager with a core belief system, a true north that guides their decisions even when the market is screaming at them to do the opposite. You can often find this spelled out in the fund's prospectus or their shareholder letters. Read them. Does it sound like a coherent strategy? Or does it sound like marketing fluff filled with buzzwords? The difference is everything. A manager without a process is just guessing, and you don't want your financial future to be based on a guess. The second piece of the puzzle is the person or people behind the process. How long has the fund manager actually been managing this specific fund? This is called manager tenure, and it's a massively underrated metric. You might see a fund with a spectacular 10-year track record, but if the current manager has only been there for 18 months, that track record is almost meaningless. It belongs to someone else. You're not investing in the past, you're investing in the future, and the person at the helm today is the one who will be making the decisions for your money tomorrow. Look for long tenure. A manager who has been with a fund for a decade or more has been through multiple market cycles. They've seen bull markets, bear markets, and everything in between. They've made mistakes and hopefully learned from them. They have institutional knowledge. Along with tenure, look at the stability of the entire team. Is there a high turnover rate among the analysts supporting the manager? If the team is a revolving door, it's a major red flag. It suggests a poor culture, a flawed process, or a lead manager who's difficult to work with. A stable, experienced team that has worked together for years is a sign of a healthy, well-oiled machine. Now for one of the most powerful indicators of all, and it's beautifully simple. Does the manager eat their own cooking? In other words, do they have a significant amount of their own personal money invested in the very fund they are managing for you? This is called skin in the game. Think about it. When a manager's own net worth is tied up alongside yours, their interests are perfectly aligned with yours. They feel the pain of a down year in a much more personal way. They are motivated not just by their salary or a bonus, but by the fundamental desire to see their own investment grow. You can find this information in a document called the Statement of Additional Information, or SAI. It might take a little digging to find, but it is one of the most telling clues you can uncover. A manager with a seven-figure investment in their own fund is sending you a very clear, very powerful signal of confidence in their own strategy. Okay, so we've looked at the strategy and the team. Now let's move from the qualitative to the quantitative, but we're going to go way beyond simple returns. The first concept we need to understand is risk-adjusted return. It's not just about how much money a fund made, it's about how much risk it took to make that money. The most common way to measure this is the Sharpe ratio. It sounds complicated, but the idea is simple. Imagine two drivers both get you from New York to Los Angeles in 40 hours. Driver A did it by smoothly cruising on the highway. Driver B did it by swerving through traffic, running red lights, and nearly crashing a dozen times. They both achieved the same result, but driver A's journey was far superior. The Sharpe ratio is like a rating for the driver. A higher Sharpe ratio means the fund manager delivered better returns for each unit of risk they took on. They gave you a smoother, more efficient ride. When you compare two funds, don't just look at who had the higher return last year. Look at who had the higher Sharpe ratio over the last 5 or 10 years. We can even take this one step further with a metric called the Sortino ratio. This is like a more intelligent version of the Sharpe ratio. The Sharpe ratio penalizes all volatility, both up and down. But let's be honest, we don't mind volatility when a stock is shooting upwards, do we? We love that kind of risk. The Sortino ratio understands this. It only looks at the bad volatility, the downside risk, the stomach-churning drops. It measures how much return you got for every unit of bad volatility. For many investors, this is actually a more useful number because it focuses on what we truly care about, protecting our capital from losses. A fund with a high Sortino ratio is one that has historically done a great job of generating gains while minimizing those painful drawdowns. Now for the holy grail of manager evaluation. Alpha. If you only learn one advanced metric, make it this one. Alpha measures a manager's true skill. In simple terms, it's the performance of a fund beyond what you would expect just from the market's movement. Let's say the mid-cap benchmark index, like the S&P 400, went up by 15% in a year. A simple index fund would have also gone up by about 15%. Now let's say your actively managed mid-cap fund went up by 18%. That extra 3% is, in theory, the manager's alpha. It's the value they added through their brilliant stock picking, their research, and their strategic decisions. It's their secret sauce. A positive alpha is the entire reason you pay a manager in the first place. You are paying them to beat the market. A negative alpha means you paid someone a fee to underperform a simple, cheap index fund. Ouch. The key here is consistency. Any manager can get lucky for a year and generate positive alpha. A truly great manager can do it consistently over 3, 5, and 10-year periods. Finding that is like finding a needle in a haystack, but it's a needle made of gold. Finally, we have to talk about the one number that is not a measure of performance, but a direct guarantee of a drag on it, the expense ratio. This is the fee the fund company charges every year to cover the costs of the manager's salary, the analyst, the marketing, everything. It's expressed as a percentage of your investment. And while a number like 1% might sound tiny, it is a relentless headwind blowing against your returns, year after year. The power of compounding works in reverse with fees. Let's say you invest $10,000. Over 20 years with an average 8% return, a fund with a 0.5% expense ratio would grow to about $42,500. A fund with a 1.5% expense ratio, just 1 percentage point higher, would only grow to about $34,700. That's nearly an $8,000 difference, all eaten away by that seemingly small fee. The manager has to be good enough to clear that hurdle before you even start to see the benefit of their skill. So when you're looking at a fund, you have to ask yourself, is this manager's alpha, their proven skill, high enough to justify this fee? Sometimes the answer is yes. A brilliant manager who charges 1%, but consistently delivers 3% of alpha is well worth the cost. But a mediocre manager who charges 1% and delivers 0 alpha is just lighting your money on fire. By combining these tools, evaluating the process, the people, the risk-adjusted returns, the alpha, and the costs, you move beyond being a simple spectator who just cheers for past winners. You become a sophisticated analyst. You're not just buying a fund, you're hiring a chief investment officer to manage a crucial slice of your portfolio. But this leads to the next critical set of questions. Once you've done all this work and you've actually identified a fund that you believe is run by a world-class manager, what do you do next? How does this one piece fit into your larger financial puzzle? How much of your portfolio should you actually allocate to a mid-cap fund? And what are the biggest behavioral mistakes investors make that sabotage even the best-laid plans? That's the million-dollar question, isn't it? Or maybe the $10,000 question, depending on your portfolio size. But the principle is the same. You've done the research, you understand the potential, you see the sweet spot that mid-caps occupy, but now you're standing at a crossroads. How much is too much? How much is not enough? Let's be brutally honest right up front. There is no single magic number. If anyone on the internet ever tells you, you must allocate exactly 17.5% of your portfolio to mid-caps, you should close that browser tab immediately. That person is either selling you something or they don't understand that personal finance is, well, personal. Your allocation strategy is a financial fingerprint unique to you. It depends on a blend of 3 critical factors: your time horizon, your risk tolerance, and what's already in your portfolio. Let's break that down, starting with time horizon. This is the simplest one to grasp. It's basically asking, how long until you need this money? Are you a 25-year-old saving for a retirement that's 40 years away? Or are you 55, with retirement starting to appear on the horizon like a not-so-distant shoreline? If you're in your 20s or 30s, time is your single greatest asset. You have decades to ride out the inevitable market roller coasters. A 30% drop in the market, which would be terrifying for a retiree, is a fantastic buying opportunity for you. Because of this long runway, you can generally afford to take on more risk in pursuit of higher returns. For a younger investor, an allocation to mid-caps of somewhere between 15% to 25% of your total stock holdings could be perfectly reasonable. It gives you that extra growth potential without completely dominating your portfolio. Now flip the script. You're 55 or 60. Your goal is shifting from wealth accumulation to wealth preservation. You can't afford a massive portfolio haircut right before you stop working. In this case, your mid-cap allocation should be smaller, maybe in the 5% to 10% range or even less. You'd likely have a much larger allocation to more stable large-cap stocks and bonds. The mid-caps are there to provide a little extra kick, a bit of growth to help your portfolio outpace inflation, but they aren't the engine anymore. They're more like a turbo booster you use sparingly. Next up, and this one is far more emotional, is your risk tolerance. This isn't about your age, it's about your gut. It's your personal risk thermostat. How well do you sleep at night when the market is plunging? Let's do a quick thought experiment. I call it the stomach churn test. Imagine you wake up tomorrow, you log into your investment account, and you see that your total portfolio value is down 25% from where it was a month ago. Your $100,000 is now $75,000. What is your immediate gut-level reaction? Is it a, ouch, that stings, but I'm invested for the long term, this is a normal market cycle, maybe it's a good time to buy more? Or is it B, oh my god, it's all going to zero, I need to sell everything right now before I lose more. I can't take this. If you're closer to A, you have a higher risk tolerance. You can handle the volatility that comes with a larger mid-cap allocation. If you're closer to B, you have a lower risk tolerance, and that is perfectly okay. Knowing this about yourself is one of the most important discoveries you can make as an investor. For a low-risk tolerance investor, even if you're young, a heavy mid-cap allocation could cause you to make the single biggest mistake: panic selling at the bottom. So, for you, a more conservative 5% to 10% might be the right call regardless of your age. It's better to get slightly lower returns you can stick with than to chase higher returns that make you bail at the worst possible moment. The third piece of this puzzle is your existing portfolio. Mid-cap funds don't exist in a vacuum. You have to see how they fit with everything else you own. Think of it like building a championship sports team. You don't just sign 12 superstar quarterbacks. You need linemen, you need defense, you need special teams. Your large-cap funds, like an S&P 500 index fund, are your steady, reliable offensive line. They're the foundation. Your mid-cap funds are your explosive running backs. They can break through the line for huge gains, but they can also get stopped for a loss. Your small-cap funds might be your nimble wide receivers, with massive upside but higher risk of failure. And your international funds and bonds? That's your defense and special teams, providing diversification that protects you when your offense sputters. So look at what you have. Do you already have a total stock market index fund? If so, you already own mid-caps. A total market fund typically holds large, mid, and small-cap stocks in proportion to their market size. In this case, you might not need a separate mid-cap fund at all, unless you want to intentionally overweight or tilt your portfolio to have more mid-cap exposure than the overall market. Many investors do this, believing in that mid-cap sweet spot we've been talking about. A common approach is a core and explore strategy. Your core is a broad market index fund, maybe 70 to 80% of your stock portfolio. Then you use the other 20 to 30% to explore by adding dedicated funds for areas you want to emphasize, like mid-caps or international stocks. So, a 20% allocation to a mid-cap fund might sound high in isolation, but if it's part of a well-diversified portfolio that also includes large caps, small caps, and international stocks, it could be a perfectly sound strategy. Now, let's pivot to what might be the most important part of this entire discussion: the behavioral landmines. Knowing the right allocation percentage is useless if your own psychology tricks you into blowing up your plan. The first and most seductive mistake is performance chasing. This is the financial equivalent of driving by only looking in the rearview mirror. You see a mid-cap fund that returned 40% last year. It's all over the financial news. Your friend at a barbecue brags about how much money they made on it. The temptation to jump in with both feet is immense. But here's the hard truth. Past performance is no guarantee of future results. More often than not, by the time a fund becomes a media darling, the best gains have already happened. You end up buying at the peak just before it reverts to the mean or worse crashes. The smart money was in a year ago. Performance chasers are often the last ones to the party and the first to suffer the hangover. The second mistake is the evil twin of performance chasing: the panic sell. We talked about this with the stomach churn test. Markets go down. Mid-caps, being more volatile, will go down harder and faster than large caps during a correction. It's not a matter of if, but when. When that happens, your brain's ancient survival instincts will scream at you to stop the pain. Sell now. Every headline will confirm your fears. It will feel like you are making the only logical choice. But selling in a panic is almost always the worst thing you can do. You're taking a temporary paper loss and making it a permanent, real-life loss. You lock in your losses and miss the eventual recovery. The people who build real wealth understand that a market crash isn't a crisis. It's a sale. It's the stock market's Black Friday event, where quality companies are suddenly available at a discount. Having a predetermined plan and the discipline to stick to it is your only defense against this emotional hijack. The final mistake is misinterpreting the role of mid-caps. It's easy to fall in love with the story, the innovative, high-growth companies, the next big thing. You get so excited that you start to think of them as the main course. You let your allocation creep up from 20% to 30%, then 40%, maybe even 50%. You've abandoned your diversified plan and are now making a concentrated bet. Your portfolio is no longer a balanced meal. It's a plate with nothing but spicy chili peppers. It might be exciting for a while, but it's an unbalanced strategy that can lead to some serious heartburn. Remember the goal. Mid-caps are a powerful component, a growth driver, the spice that can make the whole dish better. But they are not the whole dish. They work best as part of a team, complementing the stability of large caps and the diversification of other asset classes. So we've figured out the how much by looking at your timeline, your gut, and your current holdings. We've identified the psychological traps waiting to sabotage you. You have a plan, but a plan is only as good as its execution. Now comes the really granular part. How do you actually choose a specific mid-cap fund from the thousands of options out there? What's the difference between an actively managed fund with a star manager and a low-cost index fund? What are expense ratios, turnover rates, and all those other confusing terms you see on a fund's webpage? And how do they impact your real-world returns over decades? Let's pull back the curtain on the single most important decision you'll make after choosing an asset class like mid-caps. It's a philosophical battle, a clash of titans that determines how your money is actually managed. The cage match between active management and passive indexing. Imagine you want a world-class meal. You have two options. Option 1, you hire a celebrity chef. This chef is brilliant, a culinary artist. They promise to travel to exotic markets, handpick only the most incredible ingredients, and use their secret techniques to craft a meal that is, theoretically, better than anything you could get elsewhere. They are an active manager. They are making deliberate, skilled choices to try and achieve a superior result. For this bespoke service, this genius, you are going to pay a premium. A big one. Option 2. You subscribe to a high-end meal kit service. This service doesn't have a celebrity chef. Instead, it has a ruthlessly efficient system. It's analyzed thousands of recipes and identified the one that consistently delivers a fantastic, nutritious, and satisfying meal. It then buys all the ingredients for that exact recipe in bulk, packages them perfectly, and delivers them to you with simple instructions. It's not trying to reinvent cuisine. It's trying to perfectly replicate a proven winner every single time at the lowest possible cost. This is a passive index fund. In the world of mid-cap mutual funds, the celebrity chef is the actively managed fund. It's run by a portfolio manager, or a team of them, who are paid handsome salaries to be smarter than everyone else. They conduct deep research, they interview CEOs, they analyze economic trends, and they handpick a portfolio of what they believe are the absolute best mid-cap stocks that will outperform the overall market. They are making active bets. They might decide to completely avoid technology companies this year, or go all in on industrial firms. Their goal isn't to be the market, it's to beat the market. The meal kit service is the mid-cap index fund. It has no star manager making brilliant bets. Its manager is essentially a computer algorithm with one simple unwavering command. Buy all the stocks in a specific mid-cap index, like the S&P Mid-Cap 400, and hold them in the exact same proportion as the index itself. If a stock makes up 0.5% of the index, the fund holds 0.5% of its assets in that stock. It's unemotional. It's robotic. It's cheap. Its goal is not to beat the market. Its goal is to be the market, to perfectly mirror its performance for better or for worse. So why does this matter so much? Because the celebrity chef costs a lot more than the meal kit. And that cost, repeated year after year, can be the single biggest destroyer of your long-term wealth. This brings us to the most critical number you will ever see on a fund's page: the expense ratio. The expense ratio is the annual fee the fund charges, expressed as a percentage of your investment. It covers the fund's operating costs, the manager's salary, the research team, marketing, administrative fees. Think of it as a small silent leak in your financial boat. A tiny percentage might seem harmless. An actively managed fund might have an expense ratio of, say, 0.8% or 1% or even higher. A passive index fund, because it's mostly automated, might have an expense ratio of 0.1% or even as low as 0.04%. You might think, what's the big deal? 1%. I can live with that. But you're not thinking in 4 dimensions. You're not thinking with time. The destructive power of fees is not linear. It's exponential, because every dollar you pay in fees is a dollar that is no longer in your account, compounding for you over decades. Let's run the numbers. Let's say you invest $10,000 into 2 different mid-cap funds, and for the sake of this example, let's assume they both earn a hypothetical 8% annual return before fees. Fund A is the active fund with a 1% expense ratio. Fund B is the index fund with a tiny 0.05% expense ratio. After 1 year, your 8% return is $800. In Fund A, they take their 1% fee, which is $100. You're left with a $700 gain. In Fund B, they take their 0.05% fee, which is just $5. You're left with a $795 gain. A difference of $95. No big deal, right? But let's let this play out. Let's let the magic of compounding do its work for 30 years. After 30 years, your initial $10,000 in the high-fee active fund would grow to about $76,122. Not bad. But in the low-fee index fund, it would have grown to $100,137. That is a difference of over $24,000. Nearly 2.5 times your initial investment was vaporized, eaten alive by a seemingly tiny 1% fee. Didn't go to you. It went to the fund company. That is the tyranny of compounding costs. But wait, it gets worse. The expense ratio is just the cost on the sticker. There are hidden costs, and the biggest one is driven by something called the turnover rate. Turnover rate tells you how often the fund manager is buying and selling stocks within the portfolio. A turnover rate of 100% means the manager has, on average, replaced every single stock in the fund within the past year. A low-cost index fund might have a turnover rate of 2 to 5% because it only sells a stock when it's dropped from the index. An aggressive, actively managed fund can have a turnover rate of 50%, 100%, even 200%. Why is this a problem? Two huge reasons. First, every time the manager buys or sells a stock, the fund incurs trading costs, brokerage commissions, bid-ask spreads. These costs are not included in the expense ratio, but they come directly out of the fund's assets, reducing your returns even further. It's like your celebrity chef constantly running back to the store for forgotten ingredients and charging you for the gas and time. The second reason is far more sinister, and it happens outside the fund in your own tax return. When a fund manager sells a stock for a profit, it creates a capital gain. At the end of the year, the fund is required by law to distribute those capital gains to you, the shareholder. And guess what? You have to pay taxes on that distribution right now this year. Think about how insane this is. You could have never sold a single share of the mutual fund. Your intention could be to hold it for 30 years. But because your hyperactive fund manager was buying and selling constantly behind the scenes, you are handed a surprise tax bill every single year. This forces you to pay taxes on gains long before you ever plan to, destroying the tax-deferred compounding that is the key to building wealth. A low-turnover index fund, on the other hand, rarely sells. It holds. This means it generates very few capital gains, allowing your money to grow largely unbothered by the taxman until the day you decide to sell, decades down the road. It is vastly more tax efficient. So let's put it all together. Imagine two investors, active Alex and passive Penny. They both invest $50,000 in a mid-cap fund. Alex, seduced by the promise of a star manager, chooses the Alpha Titans mid-cap fund, with a 1.2% expense ratio and a 95% turnover rate. Penny, focused on costs, chooses the simple mid-cap 400 index fund, with a 0.05% expense ratio and a 4% turnover rate. In year one, the mid-cap market returns 10%. Penny's fund tracks it almost perfectly. After her minuscule 0.05% fee, she earns about 9.95%. Her account grows, she has almost no capital gains distribution, so her tax bill is zero. She's happy. Alex's fund manager also has a good year, picking stocks that also return 10% before fees. But then the machinery of cost kicks in. First, the 1.2% expense ratio is deducted, dropping his return to 8.8%. Then the hidden trading costs from the 95% turnover might shave off another 0.5%, bringing him down to 8.3%. Then, at the end of the year, thanks to all that trading, he gets a huge capital gains distribution and has to write a check to the IRS for over $1,000. His real after-fee, after-tax return is now closer to 6.5%. He's in the same market as Penny, with stocks that perform just as well, yet his actual take-home result is dramatically worse. Now, multiply that difference, that gap in performance, by 30 years of compounding. The result is not a gap, it's a chasm. Penny is likely to end up with hundreds of thousands of dollars more than Alex, simply by choosing the boring, efficient, low-cost path. So if the math is so clear, if the headwind of costs and taxes is so severe, why would anyone ever choose an actively managed fund? Why do trillions of dollars still flow into them? It's because of a promise. A powerful, intoxicating promise that is the very foundation of Wall Street. The promise of alpha. The promise of beating the market. But is that promise real? Can these celebrity chefs consistently deliver a meal so extraordinary that it's worth the enormous price tag? That is the billion-dollar question we have to answer next. To find the answer, we can't just rely on marketing brochures or a fund manager's charismatic television interview. We need to look at the cold, hard, unforgiving data. We need an official scorecard. And for decades, the gold standard for this has been the Spiva report, which stands for S&P Indices versus Active. Think of it as the ultimate referee in the fight between active managers and their passive index benchmarks. Every 6 months it simply asks one question. Did the majority of professional, highly paid fund managers, with all their resources and research teams, actually beat the simple, boring, low-cost index they're supposed to outperform? The results, year after year, are nothing short of a revolution in how we should think about investing. Let's start with the short term. In any given one-year period, a decent chunk of active managers do succeed. Sometimes it's 30%, sometimes it's 40%, and in rare volatile years it might even be a little over 50%. This is the kernel of hope that the entire active management industry is built on. It's the flashy highlight reel. It's the celebrity chef who creates one spectacular, headline-grabbing dish. It's what allows them to say, "See? Can be done. You just have to pick the right manager. You just have to pick us." But investing isn't a one-night dinner. It's a lifetime of meals. It's not about 1 year. It's about the long haul. And this is where the story completely flips. This is where the promise begins to crumble into dust. When Spiva extends the timeline to 5 years, the number of mid-cap fund managers who beat their benchmark, the S&P Mid-Cap 400 Index, plummets. We're not talking about a small drop. We're talking about a cliff. Suddenly, we find that roughly 80 to 85% of these professional stock pickers have failed. They failed to do the one job they are paid millions of dollars to do. But let's not stop there. Your retirement isn't 5 years away. Let's go to 10 years. Over a 10-year period, the numbers become catastrophic for active management. On average, more than 90% of U.S. mid-cap fund managers fail to beat the index. Let that sink in. 9 out of 10. Imagine you're standing in a room with 10 of the most highly regarded, expensive chefs in the country. You pay them a premium for 10 years, and at the end of that decade, 9 of them have delivered you a meal that is worse than what you could have gotten from a simple, cheap, recipe-following diner down the street. And over 15 or 20 years, the numbers get even more brutal. We're talking about 95% or more underperforming. It becomes a statistical rounding error. The alpha they promised, that elusive market-beating performance, becomes a ghost. A marketing myth. You have a better chance of succeeding at a casino card table than you do of picking a mid-cap mutual fund that will beat its index over the next 2 decades. So the immediate question is, why? How is this possible? Are all these brilliant Ivy League-educated managers just bad at their jobs? Not necessarily. The truth is, they are playing a game that is structurally, mathematically rigged against them. They face 2 relentless, soul-crushing headwinds that the simple index fund doesn't. The first and most obvious headwind is fees. This is the anchor chained to their leg before the race even starts. Remember that expense ratio we talked about? Let's say it's 1%. That means the fund manager doesn't just have to match the market's return. They have to beat it by a full percentage point, year after year, just to break even with the low-cost index fund. If the S&P Mid-Cap 400 Index returns 10% in a year, the index fund investor gets very close to that full 10%. But the active manager has to generate an 11% return on their stock picks just so that, after they take their 1% fee, their investor also gets 10%. They are constantly fighting with one hand tied behind their back. And that fee is guaranteed. It's taken out in good years and in bad years. It's a constant downward pressure on performance that compounds over time, becoming an almost insurmountable barrier. But the second headwind is even more profound. It's a concept that, once you understand it, will change the way you see the market forever. It's the simple fact that the stock market before costs is a zero-sum game. Think about it. All the stocks in the market are owned by all the investors in the market. Therefore, the total return of all investors as a group must equal the return of the market itself. For every dollar someone gains above the market average, someone else somewhere must lose a dollar relative to that same average. There can be a winner only if there is a loser. Now, who are these investors? Well, a huge portion of them are these very same active fund managers. They are the market. So, as a collective group, these professional managers will, by definition, earn the market's average return before fees. Then, once you subtract their management fees, their trading costs, and their operational expenses, their net return as a group must be less than the market average. It is a mathematical certainty. The celebrity chefs as a whole cannot outperform the average of all the food being cooked, because they are the ones cooking most of it. And once you account for their enormous salaries and the high cost of their fancy kitchens, their final product, on average, has to be a worse value. This leads to one final deceptive trap that lures in so many investors: survivorship bias. When you look at a list of available mid-cap funds to invest in today, you're not seeing the whole picture. You're only seeing the survivors. Funds that perform terribly don't stick around for 10 or 15 years. They get shut down. They get merged into other better-performing funds to hide their ugly track record. It's like looking at a group of lottery winners and concluding that playing the lottery is a great financial strategy, completely ignoring the millions of people who lost. The SPIVA data is so powerful because it accounts for this. It includes all the dead funds in its calculation, showing you the true, unvarnished odds of success from the very beginning. It reveals the graveyard of failed funds that the industry would rather you forget. So when we put it all together, the picture is incredibly clear. The promise of alpha for the vast majority of funds is an illusion, propped up by short-term luck, clever marketing, and the hidden history of failed products. The data overwhelmingly shows that the search for a market-beating mid-cap fund is a needle in a haystack proposition, where the odds are profoundly and persistently stacked against you. This forces us to ask a very difficult question. If the odds are so terrible, if the data is so clear, does choosing an active mid-cap fund ever make sense? Is there a time, a place, or a specific type of investor for whom this gamble is actually worth taking? And if you still decide to walk this path, to ignore the odds and hunt for that rare gem, are there specific clues you can look for to dramatically increase your chances of actually finding one of the few, legendary, long-term winners? The answer is yes. But they aren't the clues you'll find on a stock screener or a list of last year's top performers. These clues are deeper. They're about people, philosophy, and structure. They require you to stop thinking like a stock picker and start thinking like a business analyst, or even a detective investigating the fund itself. The first, and arguably most important clue is the manager. Not just their track record, but the human being behind the decisions. The single greatest predictor of future success isn't past performance. It's the persistence of a sound, repeatable process executed by a disciplined individual. Look for tenure. Has the manager been at the helm of this fund for over a decade? Have they navigated a full market cycle, including a gut-wrenching downturn like 2008 or the flash crash of 2020? A manager who has only ever invested in a bull market is like a ship captain who has only ever sailed on a calm lake. You have no idea how they'll react when the hurricane hits. Long tenure shows they've survived. It shows their strategy is robust enough to withstand chaos, and that the firm has the confidence to stick with them even when things get tough. Then go deeper. Read their shareholder letters. Listen to their interviews. Can they articulate their philosophy in a way that you can understand? Is it a clear, logical process for identifying undervalued companies or businesses with a durable competitive advantage? Or is it a bunch of jargon-filled nonsense that sounds impressive but says nothing? The great ones can explain what they do and why they do it with stunning clarity. They aren't trying to sound smart. They're trying to communicate their conviction. And speaking of conviction, here's the ultimate tell: skin in the game. Find the fund's statement of additional information. It's a boring legal document, but it contains a treasure. It will tell you how much of the manager's own money is invested in the fund. When you see a manager with over $1 million of their own net worth riding alongside yours, that's not just an investment. That's a blood oath. Their interests are now perfectly aligned with yours. They feel the pain of a drawdown in their own bank account, and they celebrate the wins not just as a job well done, but as a personal victory. The second clue is hidden in the fund's DNA, the portfolio itself. You need to look past the top 10 holdings. First, check the number of stocks. A mid-cap fund that holds 250 different stocks is not a mid-cap fund. It's a closet index fund charging you active management fees. They're terrified of being wrong, so they buy a little bit of everything, ensuring they'll never be too far from the benchmark. But this also guarantees they will never significantly outperform it, especially after fees. The legendary funds are often more concentrated, holding maybe 30 to 70 stocks. This shows conviction. The manager isn't just buying the market. They are making specific, high-conviction bets on businesses they believe they understand better than anyone else. Each company in that portfolio is there for a reason. Next, look at the turnover ratio. This number tells you how much of the portfolio is bought and sold each year. A turnover ratio of 100% means the manager, on average, replaces the entire portfolio every single year. This is not investing. This is frenetic, high-cost trading. It's a sign that the manager is chasing headlines, not building long-term value. The great managers think like business owners. They buy a piece of a company with the intention of holding it for 3, 5, even 10 years. They let their winners run. A low turnover ratio, say under 40%, often signals a patient, long-term approach that minimizes trading costs and tax consequences for you, the investor. It's a sign of a steady hand on the tiller. And finally, for the more advanced detectives, look at a metric called active share. It measures how much a fund's portfolio differs from its benchmark index. A score of 100% means there is zero overlap. A score below 60% suggests you have a closet indexer. You want a high active share. You are paying for a manager's unique insights and their willingness to deviate from the herd. A high active share is proof that they are actually doing the job you hired them for. The third and final clue is the culture of the firm that offers the fund. This is the invisible architecture that supports the manager and their strategy. Is the firm a marketing machine designed to gather as many assets as possible, or is it an investment-led boutique focused on performance? One of the most powerful positive signals a firm can send is closing a fund to new investors. Sounds counterintuitive. Why would they turn away money? Because they recognize that for a mid-cap strategy, size is the enemy of performance. A manager with $500 million can nimbly move in and out of promising mid-sized companies. A manager with $50 billion can't. They become a whale in a swimming pool. Their every move creates waves, and they're forced to buy larger and larger companies, diluting their original strategy. When a firm closes a fund, they are making a public declaration. We prioritize our existing shareholders' returns over our own profits from new fees. That is an act of stewardship so rare and so powerful that it should immediately command your attention. Also, look at the expense ratio. While you shouldn't just pick the cheapest fund, you must be wary of egregiously high fees. Fees are a direct, guaranteed, and relentless drag on your returns. A great manager is worth paying for, but the fee structure should be reasonable and fair. A firm that puts investors first will keep costs in check, understanding that every basis point they charge is a basis point you don't get. So let's bring this all home. We started this journey by acknowledging the allure of the mid-cap sweet spot, that perfect intersection of growth and stability. We navigated the danger zone, the awkward teenage years of corporate life. We confronted the brutal math that shows most active funds fail. And now we have a framework, a set of clues to find the exceptions. This isn't about finding a fund with a 5-star rating or one that was at the top of the list last year. That's like driving by looking only in the rearview mirror. This is about becoming a manager of managers. Your job isn't to pick the next great mid-cap stock. Your job is to pick the person, the portfolio, and the platform best equipped to do that for you over and over for the next decade. It's about finding a seasoned manager with a clear philosophy and their own money on the line. It's about finding a concentrated, low-turnover portfolio built on conviction, not consensus. And it's about finding a firm that values stewardship over salesmanship. The mid-cap universe is where fortunes can be forged, but it is also a graveyard of forgotten funds and broken promises. The difference between ending up in one or the other is rarely luck. It's diligence. It's the willingness to look deeper than the glossy marketing materials. It's about finding the clues that signal a true long-term partnership. The potential rewards in this space are immense, but they don't belong to the speculators or the trend chasers. They belong to the detectives. They belong to those who do the work.